Michael Loukas joining us, the CEO at TrueMark Investments, and you guys have a bunch of funds, but I'm thinking today about some of the very competitive options-based protection category. Mike, good to have you on the show.
Good to see you, Oliver. Thanks for having me.
Absolutely, long time no see. Good to see you again. Tell me generally your kind of thoughts when you're talking with folks right now about the market and thinking through the lens of your products. What is most appealing? Are people feeling like this is an environment where they do need to have some kind of guardrails on?
Yeah, absolutely. I mean, I think it's not that the risk appetite is disappeared. It's the same concept we've had for realistically since 2020, where investors are looking for a way to stay invested and still manage the downside or at least reduce their drawdown risk. And there's a variety of ways to do that and a variety of ways they want us to do that. And so it all dovetails with that concept I've been talking about for years, which is, look, it's no longer about beating the S&P necessarily, but it is about performance that's good enough or performance that's tailored to particular portfolios and a defined outcome or a defined risk as well as a defined payoff. And I think investors have really gravitated towards that, as we've seen in the last couple of years.
Obviously, options playing a key role in a lot of those strategies, including a few of your guys' strategies that you recently launched. We're going to look at two approaches: defensive income and high income. Income being the key word there. Give me a thought generally, Mike, as I go to those, but firstly, just looking at where volatility is at in this context. I mean, we've been really talking about this a lot here, which is you still have this pretty well bid volatility structure in the market right now. Is that creating opportunity to get some extra juice from these strategies?
Yeah, so the two strategies that we've launched, and I think they're a pretty innovative take on auto-callable notes, and that's what these are, and that's becoming a pretty hot topic, I think, in the market these days. But we worked with Morgan Stanley and S&P for quite some time in this to put together a product where they are based on a volatility target index. And so volatility does play a pretty significant role in how we deploy these note portfolios in an effort to gain above average cash flow for investors while still giving them some level of not only intrinsic risk protection, but we actually go an extra step and add some extrinsic or an always-on hedge to the downside to protect from significant drawdowns. So the volatility does benefit us. It does help. And certainly adding some bells and whistles that give extra protection or extra volatility management, we think is an added bonus.
Let's talk about the defensive income first here, and then the high income. PAYM, autocallables, defensive income. Tell me about what you guys are trying to hit with that. Of course, it seems like for these funds, the question is always, what do you protect? What do you sacrifice to get that protection?
Yeah, I mean, we'll say this a million times, and we always do. There's no free lunch, right? So you do take on some risk. But that risk is collared. So essentially what we have here is on PAYM, for example, which is the defensive income. It targets annualized anywhere from a 10 to 12% yield. And depending on market circumstances, could be higher than that, could be lower, could be right in the target zone. But that product itself has a lower target volatility. And so what that means is the volatility doesn't have to be as high for that target to be met and for that product to hit its income goal. That income goal, again, is protected on the downside to a certain extent as the market or volatility increases, and therefore the product can reduce exposure to the market and still achieve the same level of income. You can logically infer that in times of high volatility, these products actually take risk off the table and they still hit their income goals. And I think that's the core trade-off within the auto-callable sector.
Now, when you're thinking about, let's say you're an advisor and you've got a client who's been in stocks, they've been riding the bull train basically. What are you seeing in terms of how they implement these on top of what exists, or they have to sell equity to move into this? That seems like one of the main things that I encounter when I talk to advisors about how they're approaching these is how do they layer it in to what exists already?
Yeah, and there's lots of ways to do it, lots of equations we've come across, but I think the reality is you blend it in. I don't think that you sell to do this, but if your choice is to replace part of your fixed income allocation with this type of yield, then that's a viable opportunity. But again, this is equity linked yield, equity linked income. And so I think there's a place in your 60/40 or 70/30, for example, to blend this in. And because it's such a significant amount of yield, it's going to give you a fairly defensive posture and certainly has a downside or intrinsic risk mitigation, downside cushion inside the portfolio. So the yield is really powerful. And which side of the asset allocation equation you blend that into is a bit of a stylistic choice. But I think it can fit in both places depending upon what the investor or the advisor is seeing as directional risk.
I would imagine the more these become popular, the more it becomes kind of a new sliver in the allocation. As to your point, it kind of serves a bond-like purpose, obviously, but still an equity-derived product. The context for yields is that they were just below 4%. Bonds kind of have that self-regulating measure where yield goes up and then people want that yield, so then yield kind of stops going up. But down below 4%, a couple of weeks ago, I imagine that kind of makes the case for some of these products even stronger because, if we were back at, closer to 5, maybe a bit of a different story. But anytime it seems like investors start to find appeal in the bond market for yield, it kind of goes away pretty quick all of a sudden.
Yeah, it sure does. And,
So
and then that is,
5%
I
a
think,
long time ago. And by the way, the chart lower and lower yields for the chart.
yeah. And I think that's the reality of it, right? Even in what we consider a relatively low rate environment still on a historical basis, these are significant cash flow numbers and these are really chunky yields. And I think that serves a purpose. The entire point of a 60/40 portfolio is that you're going to have an income component that can help in certain market environments. And this is an income component plus plus that's going to help you in certain market environments. So if we had a trending market or a choppy market with lots of V-shaped drawdowns and recoveries, lots of volatility, you end up with a really significant number on the income side. And that income side, when it amounts to either your total return in your portfolio, can be a significant variable. But if you're also in the cash flow business, if you're in retirement or trying to extract as much as you can out of your portfolio, that income number in different market environments still stays really healthy. And I think that's an important variable as well.
That is a good place to look at the high income. The PAYH high income targets 15% yield, whereas the PAYM is targeting the 10% yield, right? So we've got the PAYM up, but flipping it over to the PAYH, you've got a little bit of a juicier target, right? That's the main difference here, the 15% down here.
Yep. So you've got a higher volatility target. So if say PAH has a 35%, 35 volatility target, certainly it's going to do the same thing that PAM does. It's going to take risk off the table if volatility is high because you don't need as much exposure to hit that volatility target. And if volatility is low, it will increase exposure. Again, the point being here is it has intrinsic risk protection built into the product. We also put a hedge on this one, underlying the portfolio to protect against meaningful drawdowns. But the target volatility in relation to the yield is pretty important in this one because you jumped significantly in that yield target, right? You're talking about 10 and 12 on PAM, 10 to 12 on PAM. And this one's 14 to 16. Right now, it's yielding just about 19% annualized. So as you see volatility spike, you're going to achieve that yield target much more easily and with less exposure in high vol markets. Volatility comes down, you can increase the exposure, calmer markets, but you'll still chase that yield target, and you'll responsibly increase exposure to do that. So the way this toggles back and forth again is a true asset into a yield portfolio or an asset allocation. And I think that with PayH, for those that are slightly more aggressive in their yield target, it's a very elegant way of producing that yield while responding to volatility up to 7 times daily with the rebalance of the underlying. So this is a very reactive product in terms of dialing up and dialing down exposure. And all of it dovetails together to produce a extremely healthy level of annual and monthly installment income.
It seems like moments where that we just went through, where stocks are under pressure and yields go down, is a pretty clear kind of self-advertising for this strategy. Mike, thanks for the catch up. Good to have you on the show. Appreciate it very much.